We project 6.8% of GDP growth for this year. It's below the government target. I think even that might be a stretch target for the government, for the Chinese economy to reach. The reason is partially, as we said, China is moving away from industrialization. The other part of this is anti-corruption campaign. We're going to see more accommodative monetary policy this year. We expect 2 rate cuts from this point on in this year. We expect 2 more cuts in the reserve requirement ratio. My honest assessment, the true impact to the real economy is 0. Okay, but you have only one control board. Fiscal policy is not doing much. You don't want to boost the housing market sentiment. It's only one button. But the service sector actually doing fairly well. And the same service sector actually is creating all kinds of jobs, absorbing the job losses from the manufacturing sector. So China's labor markets actually look much healthier than what the PMI or the industrial production will suggest. That's the big trend. Every decade, China has one major trend. And standing at this point, China is in the middle of economic transformation, from production-based economy to service-based economy. As assumed dollar continue to strengthen, we expect the Chinese currency depreciate against US dollar with the 2-way volatilities. And I think this is likely to accelerate further because there is a huge amount of long renminbi structured products being positioned in outside the world, especially in Hong Kong.
I say that if you look at here, my subtitle for the market is I prefer H share to A share. To a large extent, the rationale is that A share has already discounted quite a lot of good things. It may continue to move for a while, like they did in end of 2008, early 2009. But you also can see that the risks of A share having a more meaningful correction is becoming much bigger. Stock market bubble cannot last for too long. H share, to a large extent, I don't think you could say H share has a meaningful bubble in any way. There will start to be some mainland capital coming to buy the Hong Kong small caps. This one need to consider, because I think the mainland liquidity come to Hong Kong will not go to buy ICBC or China Merchant Bank H shares. It's way too difficult to ramp up the share price. They will go for the small cap. I think the small cap of Hong Kong market could increasingly behave like H shares. That I agree. Means that they will become increasingly volatile. Valuation becomes increasingly crazy. Big cap is another story.